Okay, it has been requested for me to make a video of how to set up this Ocean City water park example here. So right now what you're seeing is I've got the problem over here on the left-hand side, and over here is where we're going to be working. And so the first thing we need to do is set up all the assumptions. Okay, so let's see. Our cost to purchase is 5 million. And let's see, install is 380,000. Is that right? I think so. Let's make these dollar signs without any zeros. Let's make this a little bit wider. Here we go. Okay, we are good. Cost to purchase is 5 million. The install price is 380. The life of the equipment is 6 years, which does not need to be a dollar sign. Let's see, what else do we have? Maker's class is 7. We have 25 riders per day. We have rides per day is 150. Let's make these not, there we go. And let's see, the season will be 120 days a year. And that is also not a dollar sign. Now, ticket price is $5.25. And let's give that a couple of, oops, $5.25. And then the increase in price is going to be 4% per year. And this is all just a matter of just not having it formatting right, why that was 0 up there. And then the variable cost per rider is $1.40. And total fixed costs are $4.25. And then the removal cost, the cost to dismantle the thing, is $215, and the salvage value is $450, and cost of capital is 8.5%. And tax rate is 35%. So let's make these two percentages. So here are all of our assumptions. Okay. So this is everything they tell us in this paragraph. So now we've got these assumptions here. Okay, so now what we need to do is set up our cash flows. For the first cash flow, our initial outlay, that is going to be our cost to purchase, which was $5 million plus the install, right? So it's $5,380,000. Okay, and that's going to be a negative. So let's go ahead and set it up as a negative now. Okay. So now our after-tax cash flow. So let's think about that. Okay, so our cash flow is going to consist of our revenues minus expenses, including depreciation expense, because we use that to calculate taxes, right? Then once we've taken the taxes out, then we add back the depreciation because that wasn't actually a cash outlay. So let's go ahead and set that up. So revenues, and what I'm going to do, as usual, is set up the left-hand side before calculating things. So less variable costs, and then subtract fixed costs, and then subtract depreciation. And this gives us, let's make a line underneath this one over here. So that gives us pre-tax operating income. And then we subtract from that, we subtract taxes. And then that gives us our after-tax operating income, and then we add back depreciation. And then that will finally give us our after-tax cash flow. Okay, that makes sense? So now, let us figure that one out. Okay, our revenues. Revenues are going to be, for year one, you know what, actually? Let's set up our columns now. So we're going to say times 0, and then year 1. Okay, we're going to set these up like we did before. 2, 3, 4, 5. Okay, and center those thusly. Okay, so our revenues are going to be it's 25 rides per day times 150 rides per day times 150 riders per ride times 120 days per year times 525 per rider. Okay, so now the columns, we're going to go ahead and set them to be absolute cell references. Like that. So that's going to be our revenues. Make that $1. And then our variable cost is basically going to be the same thing, $1.40 times all these numbers, right? So that's going to be equals $1.40 times riders per ride times rides per day times 120. Okay, and again, we're going to make those absolute cell references, or at least absolute column references. Okay, you know what, let's make all of these into dollar signs with no zeros. There we go. We subtract out the fixed cost, which is going to be the same. Again, making it absolute. And the depreciation is going to be, you know what, let's leave that alone for a minute. Okay, we're going to pull these numbers out, but the only thing is that we need to grow the revenues. I'm sorry, grow the ticket price. So what we are going to do is, where it refers to the 525, what we're going to do is grow it every year. So it's going to be the ticket price, which is found in B10, times another parenthesis, 1 plus the 4%, which is also going to be an absolute value like that. Okay. So if we drag it out again, it's just going to be the same number. Let's do a little bit of an experiment and see if we can just grow the entire revenues by that 4% a year. I think mathematically it should be the same. So let's go ahead, and rather than doing it out inside of the formula, let's go ahead and grow out the revenues by 1.04. Yep, it comes out to be the same number, okay? So now, that's what we can do. Instead of building the formula on the inside, what we can do is just grow the revenues by 4% a year. So instead of having this big, long, complicated formula going forward, what we can do is just pick up last year's revenues and multiply it by 1 plus the 4%. Okay, so now that's our revenues going forward. Now we can go ahead and bring all these cash flows out. Okay. I'm going to pause the videos right now and find the depreciation sheet from the prior workbook. Okay, so I found the worksheet where I took you through the details of how to do the maker's depreciation calculation. And so if we look over here, this is the formula that was used. I think, let's see, what do we want to do? Yeah, let's go ahead and just, instead of copying and pasting this formula, let's go ahead and make it up from scratch over here. So it's going to be VDB. Okay, so our cost is this, and it's going to be negative because we've already written that as a negative number. So that's going to be our cost. 7, the salvage is this. The life is going to be maker's class 7. The start period was that weird max and min thing, right? So that's over here. So the start period is going to be the maximum of 0 and the year minus 1.5, right? Okay. And the end period is going to be the minimum of, so it's the minimum of the maker's class and the year minus 0.5. Close the parenthesis, and then the factor is 2 because it is makers. Crossing our fingers, hoping this works. But what I'm going to do is hit enter and then come back in, and if it's working properly, then I'll go and put the dollar signs where they belong. Okay, that seems to be working right. Now, which of these variables need to be absolute cell references? Well, pretty much everything except for where we refer to the year. So everything where we don't see C19 has got to be an absolute cell reference. So we'll go ahead and put our dollar signs in front of the B's. And I think that should do it. Okay, so let's see what happens if we pull it across. We don't get any kind of error message. Yep, that looks right. Okay, so that's how you calculate the depreciation. So now, put a line under there for consistency. Our pre-tax operating income is going to be the revenues minus all of those. And then we're going to calculate the taxes on that. So it's 35%, which is an absolute cell reference, times the pre-tax revenues. And then we add back the depreciation. And that gives us then our income minus the taxes plus the depreciation, which you can't see in this Excel sheet of mine because it's annoying, so plus C29. That should give us our after-tax cash flow, which it does. Okay. So we can go ahead and copy out these 4 columns, and it should work right. I hope. Yeah, that looks right. All right, so here's our cash flows. Let's go ahead and pull this one down. Okay, as I am getting ready to show you how to do the terminal cash flow, I realized that I made this cash flow calculation for one too few years. So let's go ahead and just take this whole column, and I think it will work if we take it out one more year like that. Okay, so now we've got everything lined up right, so let's figure out the terminal cash flow. Now, the thing to keep in mind with the terminal cash flow is it's not just about getting back your salvage value, right? You also need to take into account the difference between the book value and the salvage value, and then you have to pay taxes on that one way or the other, right? So let's figure out, let's just do all this down here, and then we can add the terminal cash flow that we calculate down here into this last year's after-tax cash flow. So the terminal cash flow, the salvage value is going to be $450, as we noted above. Oh, what just happened? There we go. Okay. Now, we have to look at the book value as well. So the book value is going to be our purchase price minus the accumulated depreciation that we've paid out during that whole time, right? So it's going to be the negative of this initial cash flow minus the sum of all of these depreciation expenditures, right? Now, you can see that the book value is higher than the salvage value, right? So what that means is that we actually wind up getting a tax credit for the difference. So the difference is, let's see, ours is $407,000 less than the book value. So that means that we get a tax credit of it's that amount times 35%, 142,000, right? So that means that our terminal cash flow. Okay, the other thing we need to consider is the removal cost. Right, so our removal cost is going to be pre-tax, right? So it's going to be a negative cash flow here. That's our pre-tax cash flow, but we actually that's an expense, right? So we get sort of a tax back on that, right? So so say after tax removal cost is going to be, we're actually only going to have to pay, right, net of the taxes is going to be this value times 1 minus the tax rate. Okay, so now here we go. Our after-tax cash flow terminal is going to be the salvage value plus the tax credit, which is adding a negative, minus the cost to remove. So we add the negative there. So that is our after-tax terminal cash flow. Again, it is, I'll write it out for you. It's the salvage value, okay, plus the tax credit, which since we've calculated it as a negative, we have to subtract the negative, minus the cost of removal net of taxes. Okay, so that's our after-tax terminal cash flow. So we add that then. So this is, let's see, a positive. So we add that number here. There's all the cash flows. And there it is. Again, the hard part is always just figuring out the cash flows. And the tax implications make it, of course, much more complicated. But beautiful thing about Excel, you can always go back in and change it. So now that we've got this set up, you should be able to do the analysis, calculating the net present value and IRR and doing what if scenario type things pretty straightforward. So there it is, how to set up problem 2.